On today's show, why I believe stocks will crash in 2025, is inflation about to make a resurgence, what happened to stocks during the first trade war, and leverage. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks dipped on Wednesday as investors digested fresh data, which showed inflation was making very little progress towards the Fed's 2% target. And because of that, we saw very mixed action. There was also very high impact news events from Donald Trump, tariffs, earnings, US economic data, and all of this resulted in what we saw today. And that was Nvidia, semis, technology, software, the big names all down in a significant way, including Amazon, Tesla. Apple was kind of flat. It held the entire market, the mega caps together, but Microsoft, infrastructure tech was down big, and that had to do with some of the earnings we actually saw in the space. That's why they were down big, as well as some of the news. However, the outperformers this year continue to outperform. Utilities did very, very well. Same with real estate on the back of lower rates. We also saw financials perform very, very well. Still stark outperformance there. And then it was mixed everywhere else. We saw a couple sectors lose, a couple sectors gain. The SPY was only down 0.3% today for all of the commotion, but we did see a little bit of a bounce back from about midday. The best performing sector here was real estate, and that's because we saw yields move down in a significant way on the back of everything we saw today. Healthcare up 0.6%, financials up 0.26%, then communication services, staples, energy, utilities. And the reason why the market was down big today just had to do with this right here: XLK, XLY. So Amazon, Tesla, Microsoft, Apple, Nvidia, semis. When these are down, the market as a whole is going to be down, even though the majority of sectors did gain in today's foray. Now, this is just large caps. When we break it down into the broader market, we actually see a more striking picture. Large cap growth was the worst performing factor, down 1.25%. The positive factors here were just the value trade, both in small caps, mid caps, and large caps, and the growth trade really taking it on the chin in aggregate. We did see small cap core or small cap blend down 0.1%, and then mid cap blend was actually up ever so slightly. All in all though, when you have large cap core, large cap growth down on the day like it was, you're going to get a red day in the market. You're going to get a volatile day in the market. Now, let's actually talk about why large caps were down so much, because that's a pretty big move. Because 1.24% is a pretty big move, and it had to do with Dell's earnings. Dell released earnings yesterday. They were down 12% on the back of that news, and that's because the company took a cautious approach to its forecast, its guidance, warning that AI growth will not be linear. The street does not want to hear that type of rhetoric. Now, Dell actually missed on the top line, beat on the bottom line. Margins were mixed. The problem here was that Dell server revenue, their AI server revenue, fell 9% in the third quarter. Maybe they're making servers that are just so good they don't need to be replaced, but server revenue falling 9% and the market's going to re-rate because of that. The nonlinear growth in AI servers, coupled with the slower than expected recovery in the PC market, led the company to drop the midpoint of its guidance range for annual revenues to $96.1 billion from $97. Still, Dell executives and analysts pointed to pent-up demand for its AI servers using Nvidia's latest Blackwell chip. So maybe what we're actually seeing right here is a lot of these companies deferring Hopper revenue and Dell AI server revenue for Hopper towards Blackwell. So maybe in the fourth quarter, first quarter 2025, we're going to see huge beats in that regard. Nonetheless, down big today. Is this a buying opportunity? Potentially. Tomorrow there won't be a daily recap show because the markets are closed, but I'm going to talk about stocks I like, and Dell may be one of them. We'll see if I put it in the show tomorrow. So go ahead, subscribe. I'm going to talk about 3 stocks that I really, really like and 3 stocks I will be buying into 2025. But I digress. And as a result, because of Dell's earnings, Nvidia was down 1.77% today because it's the biggest stock in the market. That's going to weigh on the overall market and market appreciation appreciation. Also, on the technology front, CrowdStrike dropped its earnings. Now, this was actually fantastic earnings. It beat expectations on the top line and bottom line. Revenue grew 29%. It maintained 97% growth retention rates, despite the issues they had at the start of the year with that Windows issue. When the stock dropped 30%, you would think that retention rates would go down, but it really goes to show the quality product and the moat that they have. However, the shares fell 6% in trading because even though management did raise guidance, it wasn't as much of a raise as the street was expecting. So a double beat and raise is not good enough in this market anymore. And so CrowdStrike affected the infrastructure space, Microsoft, Dell affected semis, and that's why we got the price action we did today, along with some of the economic data too. That played a big role in the price action we saw. Now, the latest reading of the Federal Reserve's preferred inflation gauge showed price increases were flat in October from the prior month. You can see PCE right here, year over year, month over month, as well as the core versions all came in line, 0.2 versus consensus expectations and 2.3% actual versus consensus expectations. The same was true here in the core version. And even though PCE inflation did come in line with market's expectations, the market is now grappling with the fact, has progress towards the 2% target actually stalled, and does inflation bottom out from here and move higher? So that's what the market is grappling with. Coupled with the fact we also got personal income outlays, and that actually beat expectations. So yes, consumers continue to gain pricing power, but what does this mean for the inflation story going ahead into December, into 2025? Again, the market grappling with that. However, we did get some positive data points. Weekly jobless claims rose less than expected. It hit a 7-month low as the impact of labor strikes and severe weather continued to abate. New data from the department showed 213 initial jobless claims were filed this week. The expectation was 215,000. And we also saw Q3 GDP came in unchanged, 2.8%. This is the third quarter burst revision. So right now, GDP growth sitting at 2.8%. Very, very solid. You love to see that. What really did hurt the market the most, and I think even more than the PCE data, was actually the durable goods data, right? This was very, very ugly data. Durable goods orders, the forecast was 0.5%. It actually came in at 0.2%, missed expectations by a lot. That was coming off the previous months after the hurricane and labor strikes, negative 0.4%. So the recovery not quite as robust as we had thought. And I think that really did hurt the overall market today. What also hurt the market was Trump on Tuesday tapped Jamieson Greer as a U.S. trade representative. Greer was heavily involved in Trump's original China tariffs. Wall Street is assessing what his role could mean for big new tariffs promised for the U.S.'s top trading partners. So the market was grappling with all of these things, the earnings, the fundamental, as well as the macro. Putting all of this together, that's why we saw the price action we did today. Regardless though, when we do look at market breadth, everything still looks very robust. We still had more issues advancing than declining. And then when you look at the market breadth, things look very positive, and you still want to buy these dips, because when you have the 5-day, 20-day, 50-day, and long-term averages where they are looking solid, the dips we do get, you want to scoop up those dips. And what's also telling about this is the 5-day moving average is now at 62%. This is a very noisy average, right? And we didn't actually break the 50% mark. We're actually still at 62, nearly 63%. Very solid. And there wasn't that like capitulation in market breadth. We just saw like an ordinary sell-off, also coupled with the fact that tomorrow is Thanksgiving. And I think the market just taking a bit of profits in what will be a low volume day on Friday, and probably a low volume week next week as we enter into the December period. But let's hop on the charts. Now, the S&P 500 and NASDAQ 100 were down 0.38 and 0.85 respectively. Very interesting that large caps underperformed. Look at the RSP, pretty much flat on the day, down 0.9%. The IWM gained ever so slightly. And the reason why we saw outperformance in the RSP and small caps had to do with yield. Guys, yield came down in a very big way, and that's because the market's sort of assessing, are we going into a weaker economic environment? Has the strength of the economy topped? When you have a weaker economy, yields generally move lower. That's what we saw. The 2-year 10-year, 30-year yield, all down significantly. The dollar fell 0.76% as well. Very, very ugly price action. As a result, commodities did gain. Gold did gain 0.16%. You'd think commodities would gain significantly more on such a weaker dollar, but not the case. Silver fell, crude was flat. Bitcoin, though, up 5% on the day. So if you were in crypto, if you were in Bitcoin, these alternative assets, they outperformed, as well as bonds. TLT up 0.7%, the AGG up 0.27%, and bonds still paying a very healthy yield. Look at the 10-year yield, 4.25%, with inflation right now at 2.3%, especially the core components. That's a very healthy real return you're getting from bonds, especially considering where TLT is right now, relatively speaking. You could also see some price appreciation. If the 10-year yield was to go from like 4.2 to 4%, you could see some like 3 or 4% price appreciation. On top of the 4% yield you would get, you're looking at a real return of about 7% by getting into TLT, getting into something like bonds. That could be a good play into 2025, especially if you think yields are going to move lower, but a huge if. But let's actually talk about charts, right? The S&P 500. Now, today we did actually see a little bit of profit taking. We did see the market react to news. We saw a lot of things, earnings, everything I spoke about previously in the video, and that resulted in the day we saw today, a red candle, both buyers and sellers buying and selling the rip, and we did see a little bit of a pullback. Now, let's actually pop on the one-day chart just to see everything we did, right? We saw a steep sell-off here into the midday of the session. Then we actually put in a bottom. We never saw those lows again, but we didn't retake the highs, and that's why we were down today in the S&P 500. Nonetheless, very non-constructive price action from the highs, but constructive price action from the lows, especially because we didn't take out those lows. So that means we could go higher, but this is really what we want to watch, the 59.85 area into tomorrow. But hopping back onto the daily chart, we could see, yeah, very constructive price action. Bears really liking to sell this area right here. It was the previous core resistance, but if we follow our charts, there is still a little bit of upward momentum. Core resistance here at the 6,055 level. All in all, though, yeah, we are seeing some very choppy price action at the highs, and that could probably persist into Friday, into early next week. I think the market just wants to get out of this low volume trading zone at the moment. Once we pivot into the first few weeks in December, then we can move higher. And when you have all of this high impact news, you're going to get the trade you get. So for the S&P 500, if we continue to chop around here for the next couple of trading sessions, don't be surprised, guys. We are still in positive gamma, so you want to be buyers or dips, sellers or rips, buy dips, sell rips. Our aim is to the core resistance, so that's ultimately what you want to do. But do take it into consideration, we are in a very low volume, choppy trading period with tons of news events coming at us every single day. You know, Trump making his cabinet picks, earnings, economic data, everything in between, and the market needs to assess all of that and react on low volume. And that's why the market price action can't really be trusted here today. Nonetheless, we're in positive gamma. You want to buy dips, sell rips, and if we do get to the 59.30 area, let's say we do sell off, right, guys, you want to buy the dip because I do think we're going higher. Equities look very, very constructive. The S&P 500 looks very, very constructive, and this is just looking like a higher low relative to this. And if we do find support at this area, it would just be a higher low relative to this. So I think equities look constructive for us to go higher into the end of the year. To be honest, this just looks like a typical pullback on low volume. Looking at the Nasdaq 100, a little bit uglier. We did touch into negative gamma ever so slightly. However, bulls did come in a very big way. We bought the dip and we're back in positive gamma. So if you want to buy the gamma flip looking for the core resistance, that does seem prudent, but there are some earnings issues with Blackwell that Dell flagged, so that could be a concern. That could weigh on the mega caps. Nonetheless, I think this is looking more attractive than the S&P 500 and then the RSP as well. The RSP looking mightily attractive here. It actually is just trading at the high. We haven't seen significant moves like we have with the Nasdaq 100. You know, we're seeing these sort of like big swings here in the last couple of days. The RSP sort of just trading here at these highs. We actually did go ahead and make an intraday all-time high in the RSP, but that got sold off. Nonetheless, very constructive. The RSP just keeps making higher highs, higher lows, hitting new all-time highs. I like the RSP. I also like the Nasdaq, but I just like equities in general right now. Guys, after everything we got today, Trump's pick, PCE, earnings, market momentum on low volume, the best thing the bears could do was to sell off the RSP by 0.1%. After all of that bad news we got today, this was the outcome. 0.1% down in the equal weight S&P 500. The broad equal weight S&P 500 was only down 0.1%. Small caps actually gained 0.14%. That was the result of all of today's bad news. This is an opportunity to get long. This is a signal that we will go higher into the end of the year. The market literally just brushing off these concerns. And the reason why the market weight indices were down today actually had to do with earnings. I don't think it had to do with economic data. I think it had to do with Dell and CrowdStrike's earnings. And then the market just reacting there because of the valuation concerns with like tech and how high they are. And that's why they were down big. But all in all, when you look at the equal weight broad market, there isn't really much of a concern. If you ask me, the market just said, show me the money. And that's exactly what we're seeing right now. And looking at the RTY, very similar to the Russell 2000, it's sort of holding at these highs right here. It's touching the core resistance, came down. That's exactly what happens. And if we do pull back, guys, to the core resistance here in the RTY, we do want to buy that dip, right, and look to higher prices for the RTY. I do think we're going to go see all-time highs before the end of the year. And that is about this level, right? It's not too far from where we currently are, maybe 1 or 2 percentage points, and we get there. Very constructive price action, higher lows, higher highs, new 52-week highs in the Russell 2000. We're in positive gamma in all of these indices, and you want to take advantage of these dips. Now, look, the NASDAQ guy looks really good. I like the NASDAQ. I like the RSP. I like the RTY. The S&P 500, a lot left to be desired. If it just pulls back to the gamma flip, I would like the S&P 500, but all of these indices look very, very good. Yields look good. And tomorrow we're going to talk about stocks that I really like. But yields are falling. The dollar's falling. This is something I've been talking about for a while. It's going to be supportive for equities. If yields pull back and the dollar pulls back, that's going to be a tailwind for equities into the end of the year. And I think we might actually start to see that starting today. We did see yields pull back, not yesterday, the day before. They did come down as well. So maybe the 10-year yield, it could start to really pull back like it has. We are in a daily downtrend, as you can see, coupled with the dollar falling. That's really going to help equities into the end of the year. Long term, I do think the dollar and yields are probably going to rise. Maybe the dollar more so, not necessarily yields. But in the here and now, the next big tailwind for equities is yields coming down, the dollar coming down, a cheaper cost of capital, less competition for equities. Therefore, you allocate more money into equities, and that is the next tailwind for the market. So I think that's coming in December. But in the here and now, we just need to get out of this choppy period we're in, this Thanksgiving period. And then from next week, middle of next week, we can continue the move onward and upward. Now, let's talk about the market and look at a very interesting sentiment indicator. This is the percentage of Americans who think the stock market will move higher in the next 12 months. And what we're seeing is very euphoric, very bullish sentiment. This is confirmed by stuff like the Fear and Greed Index, as well as the AAI Sentiment Survey. But nonetheless, Americans think stocks will move higher. We are officially above the 50% mark. And on average, when we have gotten here, things have seen a bit of a pullback. However, we've only ever been above the 50% zone in one other instance. So a very thin pool of data. Nothing that you could say fundamentally is sound from this. Things are bullish and we are hitting all-time highs. And Americans who think stocks will go higher. Will they? Well, normally when retail gets involved, things start to take a turn for the worst. But you can't deny the fact that we are in a bull market. Guys, look at the second worst performing sector, materials, ticker XLB, up 12.17%. To put that into context, the S&P 500's average return in the last 50 years is about 9% per year. So we're besting that by 3 percentage points in alpha. It really goes to show the bull market we're having. The healthcare index only up 8%. And again, that has to do with the Trump situation. Go look at healthcare returns in 2016 when Trump was in office the first time. Not very good. Definitely a sector you want to stay out of. And that's why I haven't championed healthcare at all. Nonetheless, the places where you want to be invested, guys, pretty much cyclicals for the next 12 months. And had you been invested in cyclical sectors, you've done very, very well. Look at discretionary, industrials, comm services, infotech, financials, all up 20% or more. And in some instances, like financials, nearly 37%. The S&P 500 all sectors included a 27% return. This is a bull market, absolutely bullish, but there are risks that we do need to be aware of, and one of them is tariffs, right? When we look at what the previous trade war was, Trade War 1.0, it really did hurt stocks. You saw from January 2018 up until right before January 2019, we pretty much trended sideways. Then we did see a massive dip after the trade war intensified. However, US stocks were hurt the least. We put in a bottom, and this just presented an opportunity for us to get long again. This was in 2018, and we had stellar returns. The US outperforming the world, as well as China, which barely broke even 2 years later. So, tariffs, yes, did hurt the US in the short term. Long term, they were great in terms of equity indices, but it did hurt the rest of the world. But we'll see how things pan out, especially with Scott Bessent and the cabinet Trump has around him right now. It's much different than what it was in 2016. But at the end of the day, tariffs do hurt growth, the economy in the short term. And for the S&P 500 for markets, margins tend to get hit the hardest. This is S&P 500 actual versus implied EBIT margins based on real sales growth. This right here was the 2018 to 2019 trade war. We did see margins get hit very, very drastically. So those are two risks to the market right now. The overall margin picture getting affected, and that will affect the overall price appreciation of stocks. That is if we get a very drawn out and intense trade war. However, when we actually look at the third year of a bull market, right, after big gains, returns tend to moderate. With the S&P 500 up 50% over the last 2 years, history suggests more modest index gains going forward. Returns were more frequently in the 0 to 10% range, following periods where the index was up 40 to 50% over a 2-year period. So don't expect another 27% in gains for this year, for next year in the S&P 500. Expect something more modest. The macro, the fundamentals, and the technicals are favorable for us to go higher, and that is the path of least resistance. Just like the trade war, there is other risks in this market, and one of them is leverage. Investors are flocking to leverage ETF bets. When we actually look at single stock leverage ETF volumes, we're seeing something very, very crazy. Investors are piling on the leverage, especially in their margin accounts. They're probably starting to max them out. Now, do take this with a grain of salt. Zero DTEs are something that's very new, and this does skew the data to the upside. Nonetheless, we do have to look at leverage. Leverage is increasing, but a more well-rounded data point I like to use is actually FINRA margin balance ratios. And yes, leverage has increased significantly here in 2024. However, it's not at the peak levels we've seen that coincide with bullish cyclical highs, like we did here in 2021, like we did here in 2018, and like we did in 2008, as well as the year 2000. FINRA margin debt is not quite there, so the market is still not as leveraged as we can get. Once we see leverage really ramp up, once we see FINRA margin debt explode to the upside, that means the S&P 500 is likely at a high. That is simply not the case just yet, and that probably means there's more gas in the tank for us to go higher into 2025. There are risks, but they're not full-fledged risks, and the path of least resistance, guys, is still higher into the end of the year, into 2025. All subject to change, but in the year and now, buy stocks, buy risk. Things look really, really good right now. And diving into the macro, guys, yesterday we got data from the conference board, the Consumer Confidence Index, and US consumer confidence improved again in November, driven by labor market optimism. These are survey respondents who find jobs plentiful minus those who say jobs are hard to get. We saw the differential tick up to 18.2%, up from the cycle low of 12.7% seen in September. And this increase was mainly driven by a positive consumer assessment of the present situation, particularly the labor market, and consumers believe a Trump economy will mean more jobs, easier jobs, higher wages, and overall a better consumer outlook. And that is why we're seeing consumer confidence readings tick up, as well as survey respondents being more confident about the labor market. And also, there is some truth to this. Both growth and the labor market are tracking stronger than the Fed's expectations. And while this does pose upside risk to inflation, if supported by growth, this is a very, very good thing. Because when you look at the unemployment rate, the Fed were expecting a 4.4% 4.4% unemployment rate by the end of the year and a 4.4% Fed funds expectation, we probably get the Fed funds at 4.4, but we probably see a 4.1 to 4% unemployment rate into the end of the year. The Fed pegged growth at 2%. We're looking at 2.8% fourth quarter tracking. Also, the GDP now saying the same thing. And then when you look at core PCE, kind of tracking on schedule as well for the end of the year. We have one more core PCE print, but things looking very, very good. Growth looking stronger than expected. The employment market looking more robust. Growth looking very, very strong. And inflation continuing to move lower. You love to see it. And that is why the equity markets and the economy is doing so well right now, which is smashing expectations. And if this continues into 2025, expect stocks to do exactly what they've done in 2024. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm.